From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, still hot inflation fuels bets on Fed hikes as drama in D.C. escalates over the debt ceiling, with corporate borrowers rushing to get ahead of the X date. We begin with the big issue, tilting towards another rate hike.
The inflation data was always going to be bumpy coming down.
There's no way, in our opinion, that the Fed is going to be easing.
I think this Fed will hike.
This whole rate cut talk, forget about it.
I still think we're about 6 months away from the first rate cut.
Probably try to hold all year.
Fed is very, very keen on getting inflation down from 5% to 2%.
The Fed, it can't be patient.
Inflation is still way too high relative to the Fed's target.
This is also a Fed that's so worried about its credibility.
It's going to remain data dependent.
It's not going to be wanting to fall behind even more.
The Fed's got more work ahead of it.
The Fed is going to have no choice but to hike rates even more.
Joining us now, I'm thrilled to say, Peter Tchir of Academy Securities and Barry Knapp of Ironsides Macroeconomics. And Peter, let's talk about something other than the debt ceiling and start with inflation, because we got PCE this morning and it was hot. Core PCE 4.7% year over year, 4.4% month over month. Both of those are above estimates. Peter, what happened to disinflation?
You know, I am not 100% sure. I thought we were going to see some of it coming through, but it keeps coming up as being inflationary, whether companies think they can continue to pass on higher prices. Clearly, there's still jobs out there. So I was in the camp that the Fed was going to be done. I see them hiking at least one more time this year at this pace.
Could that be in June, Peter?
It could be in June, especially if we get some more data like today. I would have thought maybe we get a pause in June and they go July. I think they're going to be really reluctant to pause, though, if they think they're going to have to go again. So right now I'm leaning towards a June hike of 25 basis points and no cuts this year.
No cuts this year. Okay, Barry, coming to you. Assuming we get a deal in the next few hours or over the weekend on the debt ceiling, that issue is resolved. In your view, is June a live meeting when it comes to a potential rate hike?
No.
No.
I don't think so.
Tell me about it.
No. First of all, the way if I decompose inflation into the, call it Powellflation, super core services, that was flat this month at 3. It's going to be lapping some hot comps for the next 5 months. So it's on its way lower. If you take shelter out of CPI or PCED, you're at a level, in the case of CPI, more like 2.25% or so. I think we're on track with the disinflation. We're going to see very hot headline comps over the next couple of months. It's going to take pressure off the Fed. But the real reason for me thinking that they won't be going in June is we're far from out of the woods in terms of the banking crisis. The issue is not the debt ceiling. The issue is what happens to liquidity once the debt ceiling deal is done and the Treasury rebuilds their account at the Fed, the checking account, TJA, by some $500 billion. Since the beginning of 2022, all that liquidity draining has come out of bank reserves. And so we could have another leg lower for deposit growth. Bank credit growth has slowed decidedly from 10% back in September to 1.3 now. Of course, we all, every day, Friday at 4:15, we want to know what the weekly Fed H8 data looks like. But I think the banking system is way too precarious. The liquidity build or withdrawal that's going to take place after the debt ceiling deal is done should really give the Fed a lot of caution about doing anything in June.
I think that's really interesting, and we have seen some big calls for big Treasury bill issuance once we are eventually past this debt ceiling issue. Barry, assuming that there is sort of a drain on liquidity as a result of that, I mean, where and in what markets would you expect to see that strain?
Well, I think we've already seen it in rates generally. I think that's a big part of the story, why we've had this bear flattening, move higher in rates led by the front end. I also, if you look at the Fannie Mae current coupon 30-year rate to swaps, either 5-10 blend or just the 10-year swap rate, it's out above where it was back in September and October and at global financial crisis levels of spread. So, you've already seen widening there. What I would expect to see next would be credit spreads start to widen, and then the equity market, maybe some of this AI mania start to give up the ghost. The equal weighted S&P is already back to the D low, but I'd look for the cap weighted S&P to go back to that low, and bank stocks to be at the core of that sell-off. So that to me is another reason why the Fed, should be really cautious here.
Well, for the time being, the equity market is totally in love with that AI story. But Peter, on the topic of liquidity, let's say we get past the debt ceiling issue, we do see this big wave of T-bill issuance. Are you as worried about the liquidity picture?
Again, I think it's going to kind of impact the higher risk assets more than it's going to impact credit markets. I view this very much as that Newton's cradle where the ball goes at one end and it shoots out at the other end. So I think there's going to be continuing headwinds or some renewed headwinds in the stock market. I know the past couple of days have been great. And if you look at the NASDAQ 100, it's been great for about a month. The S&P as of yesterday, I think, was still basically unchanged for the past month. So it kind of defies some of the headlines. And as Barry mentioned, the equal weighted indices are heavily underperforming. So I think this is going to be more about an equity valuation story, less about the credit story. I think credit spreads can do just fine. And we've also seen a real big ramp up in IG issuance ahead of the debt ceiling X date. I think we're going to see a pretty slow summer in terms of issuance. So that should actually be pretty supportive for credit markets from my perspective.
Well, let's talk about actually the very front end of the Treasury market here, pivot a little bit, because I do want to stay on the topic of the debt ceiling. There was a really interesting note out from a team at Credit earlier this week, led by Winnie Cesar, describing the impact of the debt ceiling drama on Treasury bills, saying that, quote, the least loved T-bills have discount yields that resemble the effective yields of several short-dated high-yield bonds. So, Peter, basically, Treasury bills trading like junk bonds. Importantly, we're not talking about junk bonds here. We're talking about Treasury paper. Is there any sort of buying opportunity here to your eyes?
I really don't pay that much attention when we're talking about yields for 2-week paper. The difference between 7% yield and 4% yield, take 3%, divide by 26. It's not an a big impact on your return. If you're talking about 5-year treasuries trading like 5-year high yield bonds, that's something. So I think this is people don't want to hold these securities in case they default, but the yield's kind of trivial because we're talking about 1, 2-week, 3-week, 1-month paper. It's just not giving you much of a signal other than people are doing the prudent thing and saying, I'd rather not own this if this is going to be one of the ones that does not get paid on its due date.
Definitely point taken there. And I mean, Barry, when it comes to that point, people don't want to hold on to this paper. Should there be a default? Who knows whether there will be, but how seriously do you think investors should be hedging that possibility at this point?
I don't think they should be, but I would tell you that, you just started to hit on the contra argument to the point I just made, that there's going to be a liquidity event that is going to reverberate out through the markets, because I think what the Fed expects and what a number of market participants expect is that the buyers of that bill issuance are going to be government money funds, right? That for both reputational and operational reasons, $500 billion has flowed into those funds since SVB went down, but they've been avoiding June bills like the plague because, as I said, operational and reputational reasons. So if the purchase of those bills was primarily financed by money market funds, and it draws down the Fed reverse repo program, the RRP program, it has no net effect on market liquidity. I'm arguing that because that trend has been primarily money coming out of bank reserves, that it'll put more pressure on the banking system. And I think that reserve flow, out of the banking system is going to continue. My old colleague Joe Abate calls it the sleepy depositors. Even last night, there was $41 billion that flowed into money market funds. But that's the big question in terms of how big a liquidity shock we get. If money funds have been avoiding June bills and we get through the debt ceiling and they take down the majority of the issuance, that'll lessen the blow of that liquidity shock.
Well, related to all of the money that we've seen go into money market funds, I mean, it's worth pointing out that bond funds overall have really been on fire, Peter. I mean, I take a long look at ETF flows, and it's really stark. If you look year to date, fixed income ETFs have taken in around $80 billion. equity ETFs have only taken in about $57 billion year to date. It's really rare to see that sort of dynamic where the bond ETFs are taking in more than the equity ETFs. Do you think that that's still the right play here, to favor bonds over equities?
I think you want a balanced portfolio. I think the one thing that happens with bonds, we're finally at, after years of ZIRP, you forget that a lot of, coupons come out, you get these monthly dividends, a lot get reinvested, right? People don't need that money every month. So you have this nice flow from reinvestments going back into the bond funds. I think people, if they were smart, kind of underweighted bonds back when we were at 1.5%, 2% on the 10-year. So they've got room to put this to work. And I do think we are not close to being done with people pulling money out of savings deposits or banks and into something yielding higher. I think that was one of those things. I look at it, we went from 13 trillion in bank deposits to 18 trillion during the 2 years of ZIRP. So they took in 5 trillion, which is about 5 times to 7 times as much as they would take in that period on a straight line basis. It came at the exact worst time for them to have investment opportunities. People didn't care at the time because there was no differential between bank yields and what you could earn elsewhere. So I think people are slowly rethinking how much they have in the deposits. Banks are slowly coming to line, and you're seeing more and more ads for banks trying to offer higher deposit rates. So there's that battle. And then you still have what's on with the balance sheet and what banks were prudent versus what banks weren't prudent in terms of how they invested those deposits. So I think this is an ongoing story, and we're looking not just at bank deposits continue to drift down, but bank deposits to come out of some of the smaller, weaker banks into the big banks. And that gets, hidden sometimes in the data. So I think we have months of this to play out, unfortunately.
Well, as Barry mentioned earlier, we're going to get an update of that data at about 4:15 this afternoon. But guys, we got to leave it there. Really great discussion. That is Peter Tchir and Barry Knapp. Thank you both so much. Up next on this program, it's the auction block. Mercedes helps to drive issuance higher for the week. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where the issuance surge marches on. We're going to start in Europe, where we had over 44 billion euros in sales. They were led by companies such as Mercedes-Benz and Vodafone. Here in the U.S., big banks JP Morgan and Citi hope to lead weekly volume to over $14 billion. May has a chance to be the busiest month so far this year. And in high yield, U.S. companies rushed the market before yields climbed any further. The month-to-date supply is almost $22 billion. That is the busiest month for issuance since January 2022. Lindsay Rosner of PGIM Fixed Income says the run-up to a U.S. default presents a unique opportunity.
We are waiting for widening. And so I think that can lead to a really interesting dynamic where you got maybe triple Bs widening, and then we'd go and pick up our favorite names and take advantage of that. So there are dynamics kind of on the margin that can happen if you do in fact have that downgrade. I don't think there's a massive forced selling in the fixed income market, but opportunities will be unlocked, and we want to be there to get them.
Joining us now, Robert Cohen of Doubleline and Meghan Graper of Barclays. Robert, let's start with you. Waiting for widening. Are you in that camp as well, or do you think that credit spreads basically reflect reality here?
No, I think credit spreads are relatively tight. Over the last year, we've been more trading volatility. I think you want to be in a position to take advantage of when markets are strong, to be a seller, when markets are weaker, to look to buy. You have to be tactical because the volatility is so great. I agree that spreads are really poised to widen. Earnings have been very strong. Everyone's waiting for kind of the earnings cliff to happen. But I think that's maybe why spreads are relatively, I call them average, because the recessionary talk that everyone's been bringing up hasn't really come to fruition in earnings. And so credit spreads have been relatively contained.
Well, Robert, if it's not the earnings cliff that's going to be the catalyst, or it hasn't been the catalyst, what would fuel that widening, and what kind of magnitude are we talking about here?
Well, we're in this interesting position. In fixed rate securities, investment grade and high yield, companies have printed very low coupons. Just to contrast, JP Morgan priced a deal today in the last week with a 5% coupon. There were high yield deals, triple C deals in 2021, printing with a 5% coupon. So those borrowers are still paying very low rates until they come to maturity. That will cause pressure. Right now, borrowers that don't need to refi can just sit and pay their very low coupons. So that could be a moment where spreads really widen when these companies across investment grade and high yield just don't want to or unable to stomach the prevailing rates that we have. The credit markets are playing this game, I suppose, of betting that the Federal Reserve is going to lower rates later in the year, and that companies can then refinance later. It's a weird kind of thinking because the Fed will lower rates because of recessionary pressures that they see. So spreads will widen in a recessionary environment. Spreads will probably widen if companies need to refi into a higher environment. It seems sort of set up to be wider in either scenario.
Well, Meghan, come in on that because, I mean, to my eyes, it's been kind of remarkable to see spreads really grind tighter here in the face of what's been very, very hefty supply. What does that say to you about the fundamentals of this market versus the technicals?
Yeah, I think, at the end of the day, it might seem intuitive, but what we're seeing legitimized in the investment grade market is that higher yields and lower volatility together are actually good for spreads, at least for the medium term here. And if we look at IG more specifically, with a 40 basis point move in the course of the last two weeks time, all-in yields now are sitting at north of 5.5%. And, aside from a couple of weeks in late February, that's the highest level we've seen since November of 2022. It's within 10 basis points of year-to-date highs. And at the same time, spread volatility is settling into what is effectively a 2-month low. That's down close to 60% from the March peak. And so credit spreads are exhibiting, I think, very little in the way of stress, despite the Fed tightening that continues to be in play. So you've got the IG corporate index at the highest point. You've got volatility at its lowest. And I think the interplay of that, without question, is continuing to attract demand for corporate bonds.
Well, let's talk about some wild card options because there was a really interesting call out there from UBS earlier this week saying that basically the impact on financial markets would be highly uncertain should the U.S. default, but that we could see credit spreads maybe widen to 200 basis points on the IG side. I mean, Meghan, I'm looking at IG spreads right now at 140. 200 feels pretty far away. In the hypothetical scenario where, we do cross that X date, what are you thinking the read-through into the credit markets could be?
Yeah, I think that's right. I think we agree with that consensus view that as we head into economic contraction, which we think has been pushed out, I think the baseline view is that was second half, but I think it could be well into late 2023, if not into 2024, before that fully materializes given the outperformance of the economic data. So, it's likely not a straight line move. And I think in the interim, what you're seeing is a growing consensus that investment grade is really the long of choice. And you can see that evidenced by fund flow data, which offers us a real-time gauge of investor demand for credits. Cash has continued to migrate into IG for the better part of the last 4 weeks. But more importantly, we're seeing it in the functioning of the primary markets where heavier than expected volumes have been exceptionally well received. At 140 billion, you suggested it, we're already within spitting distance of being the most active month in 2023. And yet it's been met with outsized oversubscriptions. On average, we're seeing 3.2 times oversubscriptions on deals. In lighter volume weeks, it's been as much as 4 times oversubscribed. And I think it's been digested well. I think 70% of deals are still trading well inside of new issues. So there's no shortage of appetite being fueled by the yield opportunity and the return of carried income that our market affords. So we think that while that might be a longer term view that we see some erosion as recession takes hold, it feels like that's been pushed out by several months.
Well, even so, IG, the long of choice, we have a great chart that shows sort of the performance of different sections of the credit markets. And what's interesting, you have IG sort of the laggard there. And up at the top, leveraged loans have really been outperforming. But Robert, there was an interesting analysis from Bank of America earlier this week saying that basically in the event of default, some of these investors in these leveraged loans are facing losses of about 80%. In your view, is the performance that you get out of leveraged loans worth the potential risk?
Well, I don't think there's a beta trade. The reason that loans have been outperforming is because shorter duration assets have been performing well in an environment of strong earnings. I actually think that when you look at the leveraged loan market, you have to separate its components. Some of it is some of the most dangerous parts. I'd call that the triple C part of the loan market. But double Bs, I think, are one of the most interesting and one of the most investable parts of the corporate credit market. They are floating, so they get the benefit of Fed funds rate increases. Double B loans yield over 8%, close to 9%, and they typically don't default very much. You're talking about a 1% default expectation of the cohort. So you're getting a very high current yield. These are near par, and low default rate. So relative to high yield and investment grade, I think it's quite interesting. When you're talking about the lower parts of the leveraged loan market, I think they're quite dangerous because they have very high leverage, negative free cash flow, terrible documents, and I would expect the recoveries to be very low. I think that below 50% is certainly possible relative to the historical framework would have been over around 80%.
All right, guys, got to leave it there. Great conversation. Really appreciate your time. Robert Cohen and Meghan Graper, thank you. Still ahead, the final spread, the week ahead, coming up next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up. Markets are closed on Monday for Memorial Day. Then on Tuesday, we're going to get another read on consumer confidence. And then Thursday, it's the big one. It's Secretary Yellen's so-called X date for a potential U.S. default. And then we're going to round out the week on Friday with the May jobs report. And that's what I want to talk about because I think that's going to be the one to watch. So let's talk about some expectations here. You're expecting to see the jobless rate come up slightly, average hourly earnings come down slightly. That would be theoretically what the Fed wants to see. We know economists have been underestimating this labor market, though. But from New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.